Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn & Associates with your metals market update, and we are now on Tuesday, the 13th of February, 2018, day before Thanksgiving. It's about 2 p.m. Central Standard Time. You know, the stock market was down early, came back up, but there's something missing in the market. You know what it is today? Volatility. For the first time, the market's quieted down, and I don't think it's good. I like the volatility, to be honest. Now, the metal markets are responding to a dollar that also dropped back 51 points at the expense of a number of currencies rallying up strongly against it. The yen, very strong, 83 points higher, 74 points higher in the euro. We start getting both PPI and CPI numbers starting tomorrow in the U.S. What's the focus going to be? I think the focus is going to be whether we're seeing inflation and how is that inflation affecting these two indicators. If we don't get the inflation readings, you probably go back to the market thinking, at least stocks, it's a Goldilocks scenario, it's still okay. If we get the inflation readings, it probably says to the market, watch out, the Fed is 2.5, 3 times probability of 3 hikes this year. Maybe there'll be a 4th. You sort of spook the market a little bit. We'll see if that analysis is on the money or off, but I'm just pointing out the different things where I think tomorrow is going to be an important day, and it's sort of like the markets took a bit of a break today in them. As you can see, the metals, gold's up a bit. And remember, you hit that lower price count at 1309.20, so you've made, in theory, your downside objective. Yes, you can go to a second, third, and so on price count. But typically when you get a setup, you will hit that first price count. And it did that. Now the question is, can there be another setup coming maybe to the upside? And certainly if you get inflation, you would think that that's the one element gold hasn't had to get itself going. When we look at a weekly chart of closes, I'm still in this down thrust. Admittedly, you have an upside bias because you're over the 18-week moving average. That's the red line. But the pattern was you made a higher high, you went through a correction low, so I'm going to give it a bit of a downside thrust right here. When I look at a daily area chart of closes, you get an exact flip-flop. The bias is down because you're under the 18-day moving average of closes. But the pattern is one where you made a lower low, came back, didn't make a lower low on a close, and moved higher. In fact, from that low, you're now up about $16. Is that just a bounce in a market that is overall still bearish? That becomes the question. When I look at this chart, I do not see a bull market. I'm sorry. I see a market, yes, I understand that I pointed out the price count, but there's nothing on this chart that is yet bullish as I see it. You still have the pattern of lower highs and lower lows. That in itself is bearish. The market is trading underneath the 18-day average of closes. That too is bearish. One of the longer-term averages, and that one is the 100-day average, we're over, and we haven't challenged it in quite a while. You have to go back to 2017 in December to get back there, and that's when this market made that $120 move. You had a correction to it. Now the question is, can it get going? In order to negate the downtrend, let's first talk that because you're in one, you'd have to take out on the current pattern 1349.30. Along the way, you have resistance at the 18-day average of closes. Could that be where the market gets sold? Well, if we put on the Bollinger Bands, you can see that you made an attack right here of the Bollinger Bands. You turned away from them. So the answer so far is yes. And what about momentum? That's the issue. The momentum is oversold and bouncing away from oversold. Unless these numbers get over the 30 level, both of them, it's an oversold market, which some of us, I teach, that becomes difficult to sell. So while the market does not have a bullish scenario going for it at this point, it also is too oversold. if you're looking to put on new positions. At least that's where I'm seeing it. That's not a trade recommendation. This is off the chart observation, and that's all that it is. When I go to the ETF of GLD, it's a bit different of a picture now. Now I've got a market that's got a lower low and a higher high. I'm not trending. Now if we come right over here and we go back to yesterday, Monday, both numbers were under 20. Day before, both numbers were under 20, but not the day before that. And lo and behold, today is a day a market could have embedded. What do I mean by embedded? Had the market been down today, you already had 2 days in a row coming in. You had Friday's action, Monday's action. Today's Tuesday. It's trying not to embed. Therefore, the market is staying in what? No man's land. That's my opinion. You've got no trend on the swing line. You have downside bias since you're under the 18-day average. However, you're staying oversold. That's not a signal of any type. GDX, take a look at this one. All right. Remember, I often think that this leads the market. You have a pattern where both numbers as of Friday were under 20. They were not under 20 together yesterday. Keep that in the back. Day before, on Thursday, both numbers under 20 and both under 20 on Wednesday. What happened is the market yesterday, on Monday, the close was such where you had a 20 reading. The only time you can re-embed is the day after you lose it, and it must be right away. You're not doing it. Unless you crash going into the close here, you're going to have 2 days out of it, which means price often, that's a signal, the price often moves to the closest of these top moving averages. I did not use the word always, and I can't use it. I can use often. You can go back and do your studies, and I think you'll find that that's a good word for this. So it's a danger sign if one is short, because you're looking for more of a rally out of the market. Let's assume it doesn't occur. Do you really want to sell into an oversold condition? Because when a market leaves an embedded reading, had it been bearish, it goes first to being oversold. Then it can either re-embed, begin the whole process, or get fully out of being oversold. But one of those two events are going to happen. When I look at the silver-gold ratio, okay, you're getting a little bounce. You got down to 79.92 yesterday. You're back up to 80.11 as we're talking. Okay, not a big deal. And as I said, I think anything in 80 to 1 is a big historic number. When I look at the silver chart, my eye goes right here, and I'm looking at these numbers. Remember, the settlement is already in. You're going to lose that embedded ability. Let's go to yesterday. Both numbers were under 20. Let's go to the day before. Both were under 20 in the day before. And all of a sudden you lose it today. Could you gain it back tomorrow? Yes. If you don't, it puts into line that the market is going to challenge, at least that's what I think, doesn't mean I'm right, this overhead resistance of the 200-day, the 100, and the 18-day average of closes. In the copper market, you never were embedded. You got oversold. You rallied back up today through the 100-day average, and just like magic, what number stopped it? Remember what I call that red line, the line in the sand? It just, a brick wall. It just stopped the market. That doesn't mean it has to tomorrow, but as I teach in my charting course, markets like to go back to neutral numbers. From there, they try to figure out what to do. It's my belief that the 18-day average of closes is such a line. In the platinum market, we have a market that's got what in embedding? Both numbers are today under, you can see that they're both under 20, both under 20 the day before, both under 20 the day before that. So today you embedded. That means I'm expecting tomorrow to see the bear step into this, as long as when you reopen tonight, you don't lose that embedded reading. You're pretty far away from 20, so I'm still bearish on that. In the palladium market, the palladium market also has the embedded reading, and as you can see, it's trying to falter. Getting under yesterday's lows would be good. You've got the fully embedded reading. Resistance is back up here at the 100-day average, and this market's still in the bear camp. In the dollar index, if we take a look at my theory, My theory is markets that are down try to rally back and figure out what to do against the 18-day average when a correction happens, or up when the market breaks back, it tries to go back there to figure out what to do. The trend is still up. Higher lows, higher highs. At least at this minute, you're still over the 18-day average. However, there has been a big warning sign, and it's right here. You got overbought in this market on Friday. Actually, you got overbought in the market, if you really want to know, Thursday. I consider any reading over 70 overbought. So the market got up here. Maybe it gets to the upper Bollinger Band, stalls a little bit on Friday, starts backing off yesterday, and today it goes right to the 18-day average. Because it's overbought, I think the market is just marking time. I don't think it's saying it's bullish, bearish, or anything. I think it's gone back to a pattern when it's overbought that it's waiting on something, and that's probably going to be that CPI number and the PPI that we're getting Wednesday and Thursday. I'd be looking very, very hard at those numbers. You know, you see me talk about these technical indicators, and I know there's a whole school of you out there that are curious about them. Well, our good friends at Modern Trader Magazine have got two indicator guides. Now, prior to them becoming Modern Trader, they were Futures Magazine. And as such, they'd put together these phenomenal booklets. Today, it's too expensive to send out booklets. You probably don't get very many of them. I'd say the print industry is dying on the vine as we look at it because it's so much easier to look at everything on your computer. Well, as you do that, I took them with their permission and took both guides 1 and 2 and made PDFs out of them, and they are the exact same publication that we can send out to you by email. They're totally free, and you'll be able to keep up with what I'm doing. Give us a call. You can go to our website. You'll see our carousel of free offers. This offering is there. Click up here, or underneath us on many websites it says click here for Ira's free information. Do so. We'll email this out to you. I'm Ira Epstein. You have yourselves a great day. I look forward to talking tomorrow, especially when we get some of these inflation numbers. Take care.